I'll call to order our meeting of December 3rd. Grant permission to Westwood Media Center to film us. Anybody else want to? Nope, not hearing that. We'll rise for our Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. And it seems like every meeting we have something different on our microphoning system. This time we talk into these microphones. We don't have to pass them. You will not hear, it doesn't amplify anything in the room, but it's catching it up on the station. So with that, I would like to welcome Nancy Hyde from our select board, and she has brought along the new Mike Gillette, Chris Coleman, and she's going to introduce, and then we're just going to go right into Pam Dukeman and her discussion. So,
okay. Well, thank you. It's a pleasure to be back here with the Finance Commission, and good evening, everybody. I'm glad the roads are clear and we could have this meeting. As you might know, we postponed our meeting from last night. But it's my pleasure tonight to introduce you to Chris Coleman. Chris joined us last Monday, so I think we're counting 5 days on the job. No, really not, because once you're on the job, they go right through the weekends. So, and it's already been very busy, especially given the first snowstorm of the year. Chris joins us, as I told many of you before, from the town of Needham. And there he was assistant town manager and operations director, and had worked in Needham for 14 years, and he has prior years in municipal government. And when we were going through the process, we were thrilled that Chris was one of the candidates, and we worked it all out, and he's on board, and now he's part of Westwood.
Yes.
So that's my introduction, and Chris, I'll welcome
thank you
to
very
you.
much. Thank you. Thank you for having us, and I just want to say the town has been very welcoming. I heard you guys are great to work with, and so I'm looking forward to the opportunity to work with all of you, and just want to say I'm very happy to be here, so thank you very much.
okay, welcome.
Thank you.
Okay. And now the brains of the operation.
Yes.
Well, here's
There you go.
now Pam Dukeman, the first time with us as the finance director and assistant town manager. So we're our first financial overview from you for the year, and we've got a lot of new members, so we left a lot of time for questions. I think it might be most helpful if we can interrupt you with questions along the way, because you don't seem to get lost when we take you off track. So feel free to ask questions as we go along. And the only dumb question is the unasked question. So, don't feel bad about asking a question.
Yeah. And we like to come in early before the budget really gets in the throes, so that we can spend this time and go through some overall material and background material and answer questions. So happy to answer any questions. I know there are some of the more experienced members who are like, okay, I've heard this many times, so apologize to them. But I do think it's good to kind of let the newer members go through some material. So what we have tonight is 3 little presentations, and I'm not going to go through every slide, but 3 different presentations that we've either done with the select board up to this point, or with you, and I'm just going to go through them. And again, as you said, I'm happy to answer questions as we go along. If it's something that I am going to cover later, I might just say that and wait. But really, I'm just trying to give an overview of kind of municipal finance in general, anything Massachusetts specific, and then look at some actual numbers from Westwood. So this is all, again, kind of prep work for how we'll start the budget going forward. So the first one is dated October 1st, 2009. That's the one on the screen. It has that date because we did send that along to you at your first meeting. I was not able to attend, so I thought I'd just go quickly through that. That's really kind of the background overview in general on municipal finance in Massachusetts, which is its own little world of accounting. So just going through this slide, our fiscal year is from July 1 through June 30th each year. Our finances are overseen and heavily regulated by the Department of Revenue. Because of our taxing ability, that's why we fall under the Department of Revenue. And they really have kind of a lot more oversight and regulation than people may realize. But they approve our actual tax rate. We have to submit everything, and when I say we, every town in Massachusetts, report all of our revenue and expenditures annually. The DOR determines the different types of accounts that we're allowed to have and how they have to be voted at town meeting or handled on our balance sheet. And as I start out and mention balance sheet, I would like to point out I have two of my staff here tonight, Marie O'Leary, town accountant, and Laura Bukhari, financial analyst. So they can jump in and help out too with any questions as we go. The DOR approves all of the town's values, so they are also involved in the assessment end. And they certify our free cash, which we'll kind of get to as we move along in slides. What is that term and what does that mean? We also, just to point out, we do undergo an annual audit. We have an outside firm. We use Powers & Sullivan, which is one of the firms in Massachusetts that specializes in municipalities. We produce an annual financial report each year, and we do have that on the website. The town also has a 3-member audit committee, comprised of residents appointed by the select board, and they do participate in the audit. They meet with the audit firm, they review the results, and then they go in and report back to the select board on any findings or recommendations. So we have completed about a month ago our FY19 annual audit. Everything went fine. The audit committee has been into the select board, and our annual financial report is online now on the website. And then finally, credit rating. We do undergo regular credit reviews by Moody's and Standard & Poor's. We hold a AAA rating with Standard & Poor's and a AA one with Moody's. Excellent ratings for a small town like Westwood. We do get those updated anytime we issue new debt or anytime the rating agency comes to us and asks for an update. So all of that is on our website, our annual reports, our various credit ratings, all the different things there. Just a quick look at some of the documents that you'll see throughout the budget process. So we do produce each fall the capital budget book. It's a 5-year look at the capital needs for the town. It includes a lot of
Excuse me,
information
Pam,
on what people...
I just want to point out that people have received this online, and we have, I have a hard copy of the book, and if you want a hard copy, you can request one through Jane.
Yes.
So all of these reports we get online, and then if you want something.
Yes, we have moved to doing them in PDFs and sending them out through Jane. We're happy to print copies for anyone who would like. We just try to cut down on the production if people are comfortable with just using the online document. So you did recently get that for the FY21 forward capital book. And then there's a couple of books when we look at the operating budget. We have a municipal detail book, which will have all of the requests coming from the municipal departments. We'll also have narratives describing what the departments do, information about their level of service. The school department prepares a similar detail book for the school budget, and you'll see those books coming out in January each year. And then we do what we call the overall budget summary book. So each February 1st, the select board needs to come out with the proposed budget at that point in time. And we'll compile everything at that point into the summary book. It'll be a summary of the revenue projections at that point. It will include the summary sections from both the municipal school books as well as the capital information. So that's really a key book. Two other things. One is the town meeting warrant book. So once we go through the budget process, your committee puts together the book that's mailed out to every resident in town with your recommendations on every warrant article that will be presented at town meeting. Because that's being mailed to every home, we kind of take advantage of that and jump in and add in some financial information to that document. So I always like to point out, this is the document. Probably, half the book is just financial information. It's really a great resource. I always bring my copy so people can see. We're not even halfway through the year. It's worn and dog-eared and ripped. Everything you need to know is in there about finances. And we've really tried to set it up in an easy-to-use format. kind of a reference page on different things. So if you wanted to take a look at debt or certain revenue or a look back at pensions or OPEB or things like that, it's really all in that document. I use it 5 times a day, every day. So we really try to be disclose all of our information, make it easy to look at, and that is the book that does it. And then the final document that I already referenced, our annual financial report. We do a comprehensive report which gives more information beyond just the basic finances. That's online on the website. That's a really great document also. Just a look at the timing of the budget. So we're working on the FY21 budget, which would start next July 1. The key dates would be voting that for approval at the May 4th, 2020 town meeting. By town charter, the select board has to come out with their proposed budget about 90 days before town meeting. So we always work with a February 1st date. So at that point, they come out with the budget proposal that then goes to the Finance and Warrant Commission to start the review process. You're required to hold public hearings on the budget, and yours is currently scheduled for March 23rd. So those are the real key dates we're working off of. The rest of the slide kind of has the detailed dates behind them. Essentially, between early fall and February 1, the Select Board is working on the budget. Pretty much every meeting, they talk about the budget in some format. Revenue, operating, capital. We keep refining the budget. We come to February 1st, we're going to produce that budget, submit the budgets to you. We'll come in on February 11th and present those budgets to you. So we'll walk through what's being proposed. You begin your review process. Your subcommittees report back on what they've looked at, meeting with the various departments. That's scheduled for March 10th. The final public hearings, March 23rd. Again, May 4th, the town meeting. And I do just want to point out, when we're working on budget, so we're working on the FY21 budget, it's really not till next fall that the final property values are set by DOR and approved, and the final tax rate. So there's really a lag with that. We're voting a budget in May that has some pieces not finalized until the fall. So we just now, in this fall, finalized for FY20 the final values, the final tax rate. And I point that out because that means that there are a couple of things in the budgets that are estimates when we're voting them at May town meeting. We come the fall, they get finalized, that's when our actual tax rate is set.
Yeah, I mean to take you off course, but I never fully understood the DOR's role relative to the assessment and how they establish that, because it's a big part of, obviously, the town's budget.
Yes?
So, can you explain how that works, or without going?
Yes, they set the rules for assessment. They determine how you have to assess value, when you have to assess value. So value in the current year, right now, we're in FY20. Those are based on your value as of January 1 of 2019 and sales from the prior year, 2018. So things like that are all determined by Department of Revenue. And every city and town in Massachusetts has to do it the same way. They require your assessing department to submit certain information to them so that they're satisfied that you have good values. So they're going to look at your sales data. They're going to look at how is your assessing department determining the values of different areas in town. You cannot set your tax rate or bill out your taxes until they approve your values. So they have a huge hand in it. And again, their role, why they can be so strongly regulating the communities is because of our taxing ability. So they actually will not let you send out tax bills until they have approved your values, approved your budget summary information, and made sure that you have a good budget, a balanced budget. Then they'll approve the tax rate.
Is that why the first 2 quarters are just estimates?
That's exactly right. So we do quarterly tax billing, and the first 2 quarters, July 1 and October 1st that go out, are preliminary bills. They are only based off the prior year. They do not have any, if you look at that bill, your home does not have a value. There is no tax rate, just based on the prior year, and there are some parameters on how we can increase that, but it's based on prior year. Now we come, and in the November time frame, we have our value set, our tax rate approved. Now we're going to do actual tax bills. So your bill on January 1, third and fourth quarter, you'll see in your bill your home's actual value for the year. You'll see the actual tax rate. And we have to go in now on those last two bills and kind of settle up. Now we know what your full bill should be for the year. We look at what have we already billed you for the first half, and we're going to bill the balance essentially over those 2 quarters. So that's exactly why. So we do, again, at town meeting, we're estimating certain things relating to value, and you'll see that as we move forward. Things are not finalized until the fall. We always have to be conservative in the estimates of things that are not finalized until the fall, because if we were overestimating certain things, we would not be able to get approval from DOR. So they're very much in the mix. And I think to a greater degree than perhaps in other states, and it's why you really don't see municipalities in Massachusetts getting into deficits or financial difficulty. Once in a great while, one of the largest cities will have a problem. DOR will step in with a financial control board, but that happens very, very infrequently, and it's because of the year-to-year oversight they have. Okay, this is my favorite slide. Some of you agree with me. We just point out that every year when we're doing the budget and when the select board are doing the overall finances, we have to handle a lot of things. It's the operating budget that people are most familiar with, our school operations, police and fire, public works, but we also have to look at the capital budget, make sure that those departments have what they need for capital equipment and facilities. We have long-term liabilities to take care of, pension and OPEB obligations. It's important that we have reserve accounts at appropriate levels. Those all factor into our credit rating. So we're always trying to look at, handling all of those things, and we're balancing all of those against the tax bill impact. If we didn't have to worry about that, we could have a perfect world with lots of great finances, but we're always looking at, well, what does that mean coming back to the tax bill and to our residents? So it's a very delicate balance. We're trying always, though, to keep all of those areas in mind when the select board puts out an overall budget. So just quickly, a couple of slides just to say what are our main accounts. This is on the revenue side. This is our pie chart of our budget revenue in the current year. $102 million, a 3.5% increase over the previous year. And yes, it was the first time the town went over that $100 million mark in revenue. You can see by the pie chart that taxes are our largest component of revenue. Almost 80% of our revenue budget is from our real estate and property taxes. That is very typical for a suburban community in Massachusetts like Westwood. You'd see a much different picture if you were looking at this same model for one of the large cities. So taxes are almost 80%. State aid is only about 6% of our budget. The large cities have a much higher reliance on state aid, some as high as 40 or 50% of the budget. But this is very typical for us. It is a difficult financing model because our main source of revenue is dictated by a very restrictive formula, Proposition 2.5. And then again, always with what we're doing, because we operate on taxes, it's always a question of what do we want to fund in the budget versus what's the impact on the residential tax bill. So because taxes are our main revenue and it's governed by a formula, Proposition 2.5, we're kind of always talking about that. This page just has some general information on Prop 2.5. It is a regulation that limits the total property taxes a community can charge, not an individual's taxes, but the total that the town can collect in taxes. In general, it lets you increase your taxes total 2.5% from the prior year, as well as adding in any new growth. So any new value that comes to town, you can add in the taxes from that new value. And then it's called an override because the town can then choose to override those limits. So it sets some limits up front. You can choose to override those if you want by vote of your residents. There are different types of overrides. A general override, you can increase your taxes for any purpose. It permanently changes your limits on what you can raise in taxes, so it kind of stays in that formula forever. It does take a majority vote by the select board to be placed on the ballot, must be passed by a majority of voters. The other type of override is called a debt exemption. So this would be if you're voting for a large building project, like a school building project. Here you can approve the project that the debt will be outside of the limits of 2.5. So this versus the general override, you're very specifically allowed for that type of project each year to add exactly what you're going to pay in debt service for that project, and only that amount. It's not permanent. When the bond ends for that project, what you can collect in additional taxes ends also. And I will just point out that in the FinCom warrant book, there's a couple of pages in there that go into this a little bit more detailed, and also has the history of the overrides in Westwood. Every override we've ever had, general or debt exemptions, overrides that were requested and passed, and overrides that failed. There's a list in the book of all of those.
So for each of those, it also requires a town meeting vote, correct?
Yes, they require a town meeting vote to approve the budget for a general override and the borrowing for a large project for a debt exemption.
So that means it would require approval by the FinCom too.
Approval by FinCom, approval by select board to go on the warrant, approval by town meeting, and then an additional approval at the ballot by majority vote of the residents.
Well, strictly speaking, if we voted to not approve it, it would still, the town meeting could override that.
Oh, yeah, sure.
But
But
It would still come through us.
Part of the process is us getting involved in the warrant.
100%. So it's town meeting approval and then the ballot. There's no set order on which those things have to occur, and we've done them over in Westwood's history either way. You could have your ballot question first and then a town meeting vote, or vice versa. The next page, we won't go through every number here, but this is the actual sheet where we're calculating our tax levy under those Prop 2.5 limits that we just talked about. So I'll just super quick point out a couple of items. The column on the most right, budget FY20. So this is what we were using when we were doing this year's budget that was approved at last May's town meeting. The circle in red where we start, the 76.6 million, you can see goes down to the year before. You simply start with your limit from the prior year, and then as you go down that column, you're allowed to add 2.5% increase, and then you're allowed to put in, at this point, the estimates of any new growth you're going to get. We have been showing that in 2 lines since University Station came online. We're not required to, and new growth is looked at in total, but we're showing 2 different lines, kind of our University Station estimate and then all other. So 450 was our estimate for new growth, 125,000 for University Station. So when we look here, this is tax revenue, not value, but the revenue from new value. The next line you can see is 0 would be where you would have a general override. So if we went out and said we'd like a $3 million override just to help the overall budget, that's where that would go in. And you can see then that that's going to change your limit, which is where you would begin your next year. So a general override gets built in up there. So we did not have one, so we moved down. We're down at 79.1 million. The next line shaded is the exempt debt line. So that's what I was mentioning. That's the, to the dollar, the principal and interest for projects that have been approved as debt exemptions outside of 2.5. So in FY20, we have $1.3 million. We have 2 projects currently running as debt exemptions. The high school project and the library project. We've not had a general override in almost 12 years, since 2007. And the other thing we'll talk about quite a bit is the high school project is approved almost 20 years ago now. We are in the final couple of years of the bond for that project. So the exempt debt 1.3, so in total, what our limit is on what we could tax, 80.4 million. So that's Prop 2.5. It lets you start with your prior year, add 2.5, add in your estimates for new growth, then it's your exempt debt, then you come to a number. That's your upper limit. There's nothing that says you have to tax that amount. That's the most you could tax without any kind of other new override. So on a budget basis, we were looking at 80.4 million, and on a budget basis, we were going to actually tax 80.4 million, leaving no unused tax capacity or unused levy. If you look over the prior years in the last line there, we have had unused tax levy each of the last several years. So in FY19, that number was $1,097,000. The year before, $1,076,000.
Pam, can you talk a little bit about your new growth and your university station growth? Your estimates are they're substantially lower than the actual of the past few years. Can you talk a little bit about why you why you underestimate those numbers?
Yes. So again, we're taking a budget to town meeting in May. We're allocating budgets to the school department, the municipal departments that are going to start operations on July 1. We don't have those actual values or new growth finalized until end of October, early November. If we overestimate the new growth during the budget process, and in a sense have town meeting approved budgets, that then when we come the fall are not supported by the actual new growth, we would be out of balance and not be able to get our tax rate certified by DOR. We would have to call a town meeting to reduce budgets, which are really problematic to do for a school budget or a municipal budget where you have, most of the money is spent on staffing. So we're conservative with our new growth estimates. When we actually get our new growth finalized, that's where you can see we're actually not going to tax to that maximum capacity. The maximum capacity would be higher, and we have unused levy, which is a good thing in a couple of ways. One, so say in FY19, unused levy of over $1 million. That means we could have taxed our residents more by $1 million, and we didn't. So that's always good news, just the bill was less than it could have been. And then it's also a good tool. It shows that we have additional capacity. We're not stretched to the penny with our taxing capacity. And that's looked at highly by the rating agencies. So
The 1.3 million exempt debt, part of that is the high school bond and part is the library bond?
yes,
What's what? How much is?
right now, that's about half and half,
Half and half. And when does the library end?
2031.
Okay, so that's,
Yep. And we're going to be talking more about that because the high school debt ending is going to be part of the discussion as we talk about how we're going to finance the next school project. But you can see that exempt debt line even on this chart. It was 1.7 million in 2016, now 1.3 million in FY20. Our debt is issued with level principal, declining interest. So as our debt goes on in the life cycle of the bond, it's a natural decline. So we talk about debt in terms of like a natural decline each year and then a drop off when the bond actually ends.
Is that amount our actual expense net of school building assistance on the high school?
Yes.
Okay. So we already
I think
have
we're gonna-
received all that money?
Talk about that in another slide, but basically, the exempt debt that we raise from residents and taxes has to be the net amount. Our principal amount on the high school bond is much higher than the number there. We do get money from the state, the MSBA. We get money each year towards that principal and interest. We have to take our full debt, less the MSBA. All we can add to our residents is the net amount. That is the old way that the MSBA did school projects. The town would issue the large bond, and then each year MSBA would pay their share of the bond. They don't do that now, and it's a much better way. Now they participate as you're building your school. They're paying their share as you go. So we would never issue that full bond or incur all that interest. It's a much better way. But the high school was one of the last projects under the old MSBA system. So we get $1.4 million a year from MSBA towards our high school debt. But when that ends in 2023, we're right on the horizon of that, you will not see that again because they don't participate that way. Just the next two slides just talk about one of the important component of the tax levy, and that's the share of the total taxes being paid by the commercial property and the residential property. And it's really important here in Westwood. The line graph shows the total commercial value as a percent of total value in town. So on the right-hand side, in FY19, commercial value was 15.9% of total value in town. If you look on the far left, FY91, commercial was 25% of total value. We had a steady decline in commercial value due to what was happening with commercial values down at the University Station area, as well as just an ever-accelerating rise in our residential values. University Station coming online in the last couple of years has helped this. In FY15, right at the start of the University Station, commercial value was only 12% of total value. So it's helped us increase the commercial share, although it's hard to make a real dent, to be honest, because our residential values keep accelerating. We have a split tax rate in town, which means we have a higher rate for commercial value than we do for residential. The select board sets that share of what the difference in the rates will be each year. But for FY19, commercial was 15.9% of value, if we look at the pie charts on the bottom. But because of the different rates, they're paying almost 27% of the total taxes in town.
So last year, I can't remember the right phrase, but last year the town agreed that citizens would receive, what's the right phrase?
TIF.
A TIF, thank you. And so that significantly changed their taxes that they paid. How does that impact this kind of a chart here when we do those kinds of TIFs?
Yeah, it doesn't impact the chart as far as commercial value. Their value is included. When we look at the new growth, back that previous slide, with a TIF, a property gets exempt for a portion of their new growth in the early years. So it's designed to kind of help a commercial project come in, get built up, get established in those early years. So it looks at what's the value in new growth as they're building, and will exempt a portion of that from paying taxes. And the schedule changes throughout the life of the TIF. No? Okay.
So when it shows taxes paid, 26.7% were from commercial entities as opposed to 74.3 residential.
Yep.
So if we were to grant significant TIFs, that percentage would change. Am I wrong in the way I'm thinking about this?
It affects it slightly. It's more in the new growth estimate on the previous slide. So when we look here and say, what can we add to our total taxing and our budget for revenue under new growth, you're not picking up
And that's
the
not gonna
full
show
amount
of the full, okay.
if someone has a TIF.
However, what's important to understand, this was a big part of the discussion, that property was already contributing to the commercial tax base, and that stayed the same.
Oh, okay, thank you.
Yes, it's
Subsequent years, the out years, as I understood it, is where the impact,
It's
and the benefit
totally
to
just the
them is-
new growth in those early years that you have to say, here's how much we would be assessing and taxing for new growth. Okay, a portion of that is waived in year one. And now you go to year two, and there's a little bit less. You get to pick it up until it's fully online.
Right. I guess I'm not asking specifically about that particular project, but in general, we talked a bit last year about the town's philosophy
Yep.
towards TIFs, and
Yep.
I'm just sort of trying to put that
Yep.
in
In a
framework.
way, if you look here, it's like the extra over their fair share in a way that commercial pays is so important to the town that sometimes towns go out to try to draw in commercial. So when we look and say commercial's paying 27% of our taxes, that's really important to us, as well as they don't participate in a couple of the major services and the expensive services that the town provides, schools and trash. I always say, I don't mean those are not related in any way, they're just the two services that a town provides that are expensive. So commercial property contributes kind of, in a sense, more than their fair share of residential value, but do not have, participate in the schools or draw services from that, as well as they're, subsidizing by 27% the taxes for trash removal that all our residents, but we do not handle their trash services. This next slide just shows for 2019 what that difference in having the split rate means for an individual homeowner. So in green was the actual bill, just over $9,200. That would have been $1,370 higher if we only had a single rate. So almost a 15% increase in tax bills with no extra services if we ever lost that split rate and went to the single rate. So that's another one of the reasons to really just try to maintain the commercial as best we can to make sure that we can maintain this benefit, or else we would have a real shock to the residential tax bill.
One reason for tips.
Just looking kind of at the overall on the expense side. So 2020, our current year, the expenditures, $102 million, or the 3.5% increase. And here in the pie chart, we're showing what are the major categories of expenses. Our biggest are the school and municipal annual operating budget. Almost 67% of what we spend is for that. The annual service we're providing from July 1 through June 30th each year through the school and municipal departments. In red, about 15% is the fixed cost or benefits. So that's where we're paying for health insurance and payroll taxes and pension costs for all of our school and municipal employees. Debt in blue is about 6%. We have some charges with the state and some other items in capital, 8% in green. And then we show our sewer budget in yellow, 4%. So our main services are for the school and municipal operating budget. We strive to have sustainable and stable budgets for those departments. And so we try not to have large fluctuations and increases one year only to be cutting back the next year. We try to stay steady with that so that they know what they can count on, and we know we can sustain budgets going forward each year.
Pam, if you extracted just the school operating budget and the benefits from school employees from the blue and red sections, what percentage of the total would that be?
Yeah, I think I have that on a slide we'll see tonight. Might not be in this packet, but the next slide shows the components of that operating budget, but there's another one coming up, Chris, that has the benefits split too. Yeah. So yes, most of the operating budget is the school budget. In FY20, just over $46 million in blue, municipal $22 million in red, fixed cost 15, and the debt $6 million. That's a very typical array, again, for a suburban community with a highly rated school system. That's what you're going to see. If you looked at.
Well, my question wasn't totally answered. So even on this slide,
Yep.
how much of the yellow bar
Yep.
is school?
I think it's about half-half. I have it on another slide that we're going to look at tonight.
All right, so really the school is
Yep.
53 million?
Yep.
Okay,
Yep.
got it.
Yep. And just the bottom of this graph, we're showing the rate of increase year to year in those operating budgets. So in the most recent years, we've been in that 3 to 3.5 range for school and municipal. In FY16 and 17, we were a little bit higher than that. And you'll see that when we look later, we were at over 5% increase. We used some of the university station revenue to meet that. We really can only meet under the normal Prop 2.5 budget about a 3% increase in our operating budgets each year. To do more requires an override or some other kind of revenue, such as from new commercial development. We just have a couple of quick slides here on how does a town borrow money. And we've already kind of touched on some of this. Town meeting has to authorize the town to borrow money. It requires a 2/3 vote, a higher than majority vote because you're committing future town meetings to your decision. So it requires a 2/3 vote for any borrowing. State law governs what we can borrow for. So again, DOR plays a large role here. Pretty much we can borrow for long-term assets. We cannot borrow for operating budgets or to solve deficits. It's pretty much, like in your personal finances, you can take out the mortgage. So we can do that to pay for large buildings or equipment. We cannot run our operating budgets or year-to-year budgets through borrowing. And as we've already mentioned, if it's a debt exemption project, it also requires a vote at the ballot. Once we have town meeting authority to borrow, we actually issue bonds. That's the town treasurer's responsibility. We have an elected town treasurer, Jim Gavin. He's been in place for a number of years now. I want to say almost 20 years. Does a great job. We go out to borrow. We're going to get that credit rating updated from the rating agencies because our buyers of the bond want to see that. A better credit rating helps us get a better, lower interest rate on the bond. The treasurer would conduct a public bond sale. We can combine lots of things into one bond sale. Sometimes we may borrow short-term before we run that into a long-term bond. At the end of the bond sale, we receive the money, enter into the repayment schedule, and then each year in our budget, we show those principal and interest payments to repay the bond. These next couple of slides just show you some information on our current outstanding debt. The bar graph at the bottom shows the debt outstanding at the end of each fiscal year. So in green, at the end of FY19, June 30th, 2019, we had just over $40 million outstanding in debt. And on that bar graph, you can see over the last couple of years, we had that number was higher as we issued debt for the police and the fire station. The total outstanding went up. We've not issued new debt now for a couple of years, so as we make our repayments, the total outstanding has come down. We did about $30 million in bonds since 2014. Excellent interest rate environment. We were getting 2.5% interest on those projects. And then the next slide shows how our repayment schedule going forward for that $40 million looks. And we look at that in the two pieces. The top one is the debt, again, that's outside Prop 2.5. So in green in our current year, FY20, we have $1.3 million. So that's the same number you saw on that slide on our tax levy. The exempt debt, 1.3, the net amount for the high school and the library. The high school debt ends in FY23, so only 3 payments left. And the library 2031.
What interest rate is that bond at?
Sorry?
What interest rate is the bond at?
The high school? I think it's down about a 3. It was a 20-year bond. The town treasurer refinanced it halfway through. So in 2012, he was able to refinance that down at a much lower rate than the initial offering. The chart at the bottom shows that same debt payout for the debt that's within 2.5, so kind of covered within our regular budget. In green, FY20, $3.2 million. Our next drop-off, we have a DPW bond that ends in FY22. There was a $4 million bond issued 10 years ago. We'll make our last payment in 2022. That will allow us, we'll talk about a proposed DPW bond that could be issued and come on and fill the space within the current budget as that debt drops off. One whole packet down, ready for the next one?
I was looking through this, you have one point where you're talking about OPEB a little bit. If you can kind of incorporate in there a little bit about how pensions work for what OPEB is and how the pensions work and what responsibility we have and where they come from and all that.
Okay. Let me just hit the slide, yeah, slideshow. No, sorry, you were good on the other one, sorry, yep. Thank you, Laura. The 1028, and just go up to the slideshow at the top. Thank you. So this is dated October 28th. This was the actual presentation we went through with the select board at their meeting, and so I just wanted to make sure you had the same material. It's quite long, but we've already kind of been through some of it, so I'm going to go quickly. But what we do each year, the select board in the fall looks at, first of all, we go through with them, how did we close out our most recent fiscal year? So those are the first couple of slides. Then we do like a general reminder, where are we with different things? Our reserve accounts, our OPEB, different revenue sources. We kind of walk through that, and we do this just as general background information before we start the next year's budget. So I'll go through this. And this was just a little bit of a layout how they look at things. In October, they were going through that year end and getting this update. In their November meetings, they did that tax shift, setting the shift between commercial residential. They started reviewing capital budget items for FY21. Select Board has 2 meetings in December. They'll continue that, continue looking at the revenue and expense projections for the budget, continue their review of capital budget, look at the municipal operating. They'll continue that again in their January meetings and kind of working up towards that February 1 deadline when they'll produce their budget recommendation at that point. So pretty much at every meeting with the select board from late fall through February 1, they're talking budget in some aspect. So first, just looking, how did we end FY19? And we'll talk about if anything has implications for the next budget year. But looking at the revenue side first, so this was our pie chart for revenue in FY19, $99 million in total revenue. Again, most of that from taxes. We talked about how Prop 2.5 is a difficult model to work with budgets. But on the flip side, because most of our money comes from taxes, it's a very easy model as far as how do we end a year and how are collections. So our collections and taxes are excellent. 99% of the funds are collected by June 30th each year. Because of that, we always have a consistent, strong closeout in our books. That's a typical collection rate for a suburban community where most of our property is in owner-occupied, single-family residential homes. Pretty much you have to pay your taxes, so people do. We don't have difficulty kind of collecting outstanding taxes. Our residents do a great job. Our collection department's collector's office does a great job. Just a couple of items to show any past due taxes we have as of June 30th. In tax deferral, we had a receivable for $455,000. Tax deferral is a program for senior residents in town who meet certain income eligibility requirements, who can decide to defer or not pay their taxes until their home is sold. There's a lien put on the property, but then they are not required to pay taxes, and when the property is sold, the collection comes at that point. So we had $455,000 outstanding in that program, but that's for all years. If we look at prior years, you can see that the balance is similar. The end of FY18, $475,000, FY17, $495,000.
How many properties does that relate to?
Right now, that's about 15 to 20. I show those older years just to kind of show you that it's just pretty consistent. We don't have a huge buildup. New people come on every year and a few homes drop off every year. So it's kind of a rolling account where we're about that same amount at the end of each fiscal year. So that's a nice program for those eligible seniors, and that is certainly not any kind of large past due amount for the town. The second line there is on tax title. So people, homes that are not paying their taxes but are not in some kind of authorized program, the town can put a lien on that property. And we will collect those taxes at some point, either through foreclosure or, again, when the home is sold. At the end of June, there was $606,000. And again, I point out that's our tax title for all years. So we're collecting, $70, $80 million in taxes every year. All we have outstanding in total is $600,000. And again, if you look at the last couple of years, the June 30th balance, FY18, $500,000, FY17, $650,000. It's consistent at about that same level every year. Again, showing that a couple of new homes might come in every year, but a couple are cleaning up and kind of coming off. So we don't have any problem with kind of past due collections. Making sure all homes pay their taxes is part of the process to make sure that the taxes is a fair and equitable process. Just looking at a couple of other revenue sources, state aid, the bar graph shows our total state aid collections each year. You can see that it's been just very steady, no real dramatic increases or decreases. If you looked at this bar graph over a prior 20-year history, you'd see something much different. We used to have kind of large increases in state aid and then drop-offs when the state budget had difficulty, and then kind of a build-up again. Now it's just been very steady, minor increases each year. We've had no disruptions in any collections during the year. Our final state budget we're showing in green. At town meeting, we had estimated state aid, we had level funded at $6.2 million. The final state budget was a little bit over that at $6.4 million. And at the bottom of the chart, we're showing what those increases came in. Chapter 70, that's the school education money, had an increase of $160,000, and the municipal general aid, $20,000.
Pam, I was wondering if you could comment on, there was just a recent bill passed that changes the formula for
Yes.
the education aid. How is that expected to impact us?
Yep. So Chapter 70 is the education aid, and it's one of the largest items in the state budget, and that's when they're allocating out that aid to all communities for their school systems. So our Chapter 70, I believe out of our total state aid is about $4.5 million we get each year for the schools. I mentioned early on that state aid is only about 5 or 6% of our budget. So even when there's fluctuations or increases to the formula, doesn't really make a great difference for us. I know the state is still kind of finalizing how that Chapter 70 change is going to roll out. It's going to be some increase for Westwood, but not significant. They're increasing the minimum increase they give each year. They always have some minimum amount per pupil that they'll increase Chapter 70. So they're making some increases to that. But some of the other increases in the formula are not going to affect us. They're kind of driven more to help the large cities that I was talking about, with heavy populations of non-English as first language students and things like that.
I just didn't know if it was a zero-sum game, if they're getting more, we would be getting less, but you're saying not
Oh,
really.
no. That's one of the difficulties the state has in adjusting that formula. If there's areas where they want to kind of help out certain areas, they cannot do it at the expense of the other towns. Because even though it's not a significant amount of our budget, it's important to us. And if there was a reduction to that, that would affect what we could provide to our schools. So they never kind of take away, they just won't give a town like Westwood as much as they're going to give to some other communities. So we're still seeing the rollout of that and what that will mean. So it'll mean some increase, but not significant.
Okay.
Just one more category of revenue, local receipts is a category. The bar graph shows the collection. The largest item in this local receipts category is motor vehicle revenue, the excise revenue. The bar graph shows the actual collections each year. So $3.7 million shown in green for FY19, up from the year before and up significantly from a couple of years back. So the motor vehicle activity has been quite strong over the last couple of years. The other major item in the local receipts overall category is building permits. That's also been quite strong based on all of the construction and renovation activity in town. So $782,000 in FY19. You'll see when we start to go through the budget, We're conservative in our estimates of revenue for motor vehicle. We don't want to build our budget on a higher expected increase for motor vehicle. Because in some years, going back to FY '08, '09, '10, we saw decreases in motor vehicle activity. So if we overextend and build our budget, and then there's some economic downturn that affects this revenue source, we could be in trouble. So we don't build the budget and spend on a high level. When we collect over budget, that all flows into free cash. We'll go through what that is. We then have it available to use in the budget in the future years. But it is an important thing that we do in the budget is to not kind of overextend and chase revenue and build our budget on that. We try to be more conservative. And then as the revenue come in, it gives us a good source to fund items with free cash. But if there was a downturn, we would have our base budget in place.
Is our collection experience the same with motor vehicle as it is for the property taxes?
Yeah, it is. It's only slightly less. It's a harder bill. Like we bill 16,000 motor vehicle excise bills. There's more fluctuation if people turn in a car or a plate or move. The motor vehicle bill gets adjusted. So it's a more cumbersome revenue source for us. But there is a tool now that's probably been in place for almost 10 years, where you can, if you don't pay your motor vehicle excise bill, you can get a flag on your account at the registry. And so we don't kind of keep pursuing you, but when you go to renew your license or registration, it pops up. So we collect it at that point. Prior to that tool, motor vehicle revenue often went uncollected, because if someone moved to a different state, or it was hard to collect. But now with that tool, pretty much, we're gonna end up getting that collection. So that's the revenue side. Oops. We're gonna look at the expense side. And the first sheet we're gonna look at is snow and ice, which is timely for today. We point this out only because snow and ice is the only account that we're legally allowed to overspend. Everything else, whatever town meeting votes, we cannot spend a penny more without an additional town meeting vote. The Mass DOR lets you do something different for snow and ice, so it's something we talk about. The bar graph shows our annual expenditure on snow and ice, and you can see that it fluctuates wildly depending on what type of winter. In FY19, we spent $538,000. Our budget was $450,000. We supplemented that budget at town meeting by $100,000. So we actually ended up with a $550,000 budget, spent $538,000, had $12,000 left over. We have recently, in recent years, increased that base budget. So even though we can always spend whatever we need to, we have to pay for it. So if our budget's not high enough at the end of the year, we're trying to scramble to fund whatever we actually paid. So for many years, our budget was $141,000. In FY09, we increased that to $250,000. FY18 increased it to $350,000, and now recently have increased that to $450,000. And we're comfortable right now with that budget. It just means there's less for us to have to cover if we go over that $450,000. And the state has a process in place that if we come up to that $450,000, we're ready to go over our budget. The DPW director has to come to the town administrator, request approval to overspend. When that's granted, we're allowed to overspend up to a certain amount. So the administrator might say you can overspend by $100,000 or $200,000. And then again, we have to accommodate at year end whatever we went over.
So we won't have Todd coming to us anymore.
Right, it's only been a couple of years now. It used to be select board had to approve it, and then the finance commission. Now it's the town administrator. But we update you when that happens so that you know we're going to be looking to supplement that budget at town meeting. And if the winter is like December 1, we're going to be in trouble. Hopefully not. Maybe this is the early blast. And done. Just moving on, other expenditures in FY19. So we mentioned the operating budget. It's from July 1 through June 30th. We're not allowed to carry over budgets into the next year, so things end or close out. Our overall budget in FY19, $86 million. We had turnbacks of about 1.4 million, or 1.6%. And that compares quite favorably with the last couple of years. FY18, the turnback was 1.2%, FY17, 1.3. So meaning not every dollar that's budgeted and approved by town meeting has been spent. The little chart in the box on the right-hand side shows you by category where that turnback is coming from. So in FY19, of the 1.4 million turnback, the majority of that is coming from the benefits and reserve accounts. 850,000 in benefits, reserves 330,000. And we run about that same amount each year. So in our benefits budget, the margin's about 5%. We have to allow for fluctuations during the year, meaning if new employees came on and took health insurance, we have to provide for that. Maybe the person they're replacing did not take the health insurance. But whatever budget is not used closes out at the end of the year.
So on the municipal line, I notice the school really spends their money, all of it. The municipal side, usually that's staffing that isn't filled, like the teen librarian, say, or, you know.
Yes, so the school budget typically is just about at zero because they have a bottom line authorization. So as they near year end, they are allowed by the Department of Revenue to handle any bills or any expenses, anything for the students that might help them in the next year's budget. So they could wait and see where they're at year end, and then at year end they could purchase, paper or supplies or books or material. Right. And so they can get down to close to the full amount of their budget. And again, that's typical for schools and set by the DOR rules. The municipal, because we have different departments budgeted by town meeting, sometimes we have fluctuations where one department might have a vacancy for a while, so there's some additional revenue. The turnback was about 200,000. I will point out that the select board sometimes can supplement the municipal budget during the year from a reserve account they have. So if a department needs additional funds, even though we know we might have additional money over in a different budget, we can't make that transfer. The select board votes from the reserve account, and pretty much what they've allocated ends up being what is turned back.
Okay.
So in a sense, we're spending our full amount, but it's coming from a transfer and then a turn back. So we've gone through now the revenue side and the expense side, and really we come to free cash, which is how we end the year. In a sense, free cash is retained earnings. It's the worst term that we have in municipal finance. Free cash, everybody's like, what the heck is that? It's really, the state requires us to have a balanced budget. So we're balancing revenue versus expenses each year. That's what they're approving, that's what town meeting's approving. Any revenue that comes in higher than budget flows into our year-end bucket or retained earnings. So when I pointed out that motor vehicle revenue is coming in higher than our budget, it's coming here. On the expense side, that unused or turn back. So a budget is set, we're not using every dollar, it comes in here. Department of Revenue at year end, once you close your books, there's a lot of financial reporting that our town accountant and our finance departments have to do. We have to submit our balance sheet. We have to submit revenue and expenditures. DOR goes through all that, and in a sense is saying, here's how much you have at the end of the year. They certify it. They give you an amount. It's called certified free cash. It's now available to be used in future years, and it requires a town meeting vote to do so. So essentially, we're planning budgets to be balanced. They're always going to come in better than balanced. Again, I pointed out because of the way Massachusetts does things, we're not going to be under in our revenue. It's very hard to do that. They want you to be conservative. We're not allowed to overexpend. So there's always going to be kind of some turn back. That's free cash. So the bar graph shows in blue the amount of certified free cash each year. So there's a new number every year. It's not cumulative. Kind of you get your one number, and then the next year, you get a new number certified. The green shows how much is used each year of that certification. So again, town meeting vote. When you can see by the bar graph, we're not using the full amount, and that's part of our financial policy. You can see over on the left side of the chart, 09 and 10, some difficult budget years. We were using every dollar we had of free cash to kind of get through the budget. We've been able to be more disciplined in recent years, be more in line with our financial policies. And because of that, our overall balance is a bit higher because there's like a beginning balance. We're not using all the amount. There's a balance that's beginning that then the year closes out revenue and expense into it. So a very bad term, but a very good source of revenue. And we'll look as we go further in the budget on how do we apply this revenue to the different budget items and that town meeting votes.
What's your view as to what percentage of certified free cash we should be using?
You're just setting me up perfectly tonight, Chris, because that's our next slide. You're asking all the right questions. So this slide shows unused free cash each year. Our target is about $3.3 million. So based on our financial policies, we should kind of have sitting, not used, about $3.3 million. That would be what the town would have available in case of emergency, and it would be a range that the credit rating agencies are looking for. So you can see that we don't quite meet that target. We always start our budget with that target in mind. So in FY19, our budget was based on meeting the target. We only use free cash for capital or one-time uses or to clean up snow and ice. We never, by our financial policies, apply free cash to the operating budget because it's really not an ongoing revenue. So we only use it for capital. So we start out our budget with using the amount of free cash that perfectly fits our target. Sometimes as we go through the process, there's additional capital that we want to do. There's additional kind of one-time warrant articles that town meeting is looking at, and we might use free cash for that. And as long as we're within the range of our target, that's perfectly fine from a financial perspective. We're not, again, applying it to operating budget. We're not using all of the free cash like we did over on the left-hand side of the graph. So again, we've been much improved, much closer to meeting our target each year. So that was our closeout of FY19. Now I'll just go super quick. We're just looking at what we call kind of key financial items, just various accounts, different things, just to kind of give you an update. Where does that stand as of June 30th? Again, the select board kind of uses this information as their background when they start to develop the next year's budget. So looking first, our stabilization fund. This is our main savings account that we have, a really important component of our credit rating. We have a financial policy that says this should be about 4% of our net overall general fund revenue. Our target should be about $3.4 million. In green, our current balance shown in FY20 is 3.3. So we're in very good shape with this. If you look on the left side of the bar graph, we weren't in shape. We, through a couple of one-time build-up of revenue, we're able to build this up. And over the last several years, we've just done a small transfer each year. Transfer from free cash into this just to keep us on target. As it is a percent of revenue, it does increase each year. So in the most recent year, we did a $125,000 transfer from free cash, and we would continue that in the FY21 budget. So really good shape with this. This is not money that we would look to use in the budget process. This is like for homeowners where they say you should have a certain amount set aside, protect you in case of emergencies. That's what this is. This is the safety account that we don't look to use. We look to have set aside. It's an important component of a credit review.
How does that differ from the free cash fund?
So it's similar. Our overall policy says that we should have 8% of our overall revenue set aside. And we do half in stabilization and half in free cash. Different towns might do that differently. You might see some towns with a much higher free cash amount and lower stabilization. They're looking at the same target, but the split. So really, it's just the matter of we think of this as we're not really looking to use this, the free cash. We are voting some of that at town meeting, but really it's similar in saying that's what we should have in reserves, about 4% here and 4% in stabilization.
Are there different avenues from removing it from the specific accounts?
Yes, that's a great question. So the stabilization is just a little more locked up. It sits in a separate account. It earns its own interest. It keeps the interest that it earns. It takes a 2/3 vote of town meeting to use the stabilization. Free cash is just a majority vote
Majority vote
of
of,
town meeting, to use it. Yeah. So they're both the reserves. Just a little, this is a little more kind of locked up long-term. We would not be using this as part of the budget process.
It's frequently referred to as the rainy day fund. And I know a member of the school committee used to say, is it raining enough
Yeah.
yet? But it has never rained enough for us to use it. We've never drawn money out of it.
That's my question. What kind of event would prompt the select board to recommend spending from the stabilization fund?
So we talked on those early slides about state aid. Say there was a dramatic shock to the state budget and they cut our state aid dramatically, $500,000. That would impact our operating budget. That would impact our school budget.
They
If
did
we
it one year,
wanted-
mid-year, so.
And, yeah, and if we wanted to mitigate that impact, we could use money from stabilization to help us kind of get through that process. We actually, in our financial policies, talk about if we use money from stabilization, how do we build it back? So if we had some shock like a state aid dramatic cut, and we used stabilization, we would, as part of that discussion, say, are we going to mitigate the whole cut? Part of it? Is it a one-time cut, or is now that the lower budget? And if so, then how are we going to kind of rebuild the amount in stabilization? So it's to help in something dramatic like that, to help stabilize the operating budget and your services if something dramatic were to happen.
Sorry, Pam, not to belabor the point, but along Chris's question, how do you determine how much free cash to use versus stabilization in terms of the rainy day need? So when do you go to stabilization or as opposed to just relying on a free cash to make up a
Yeah, we would
shortfall?
always use the free cash before stabilization. This is really more the
To zero?
long-term.
You'd go to zero in free cash before?
That's not the preferred, but if it was a dramatic, situation, we would use the free cash, definitely before the stabilization.
I liken it to taking a borrowing against your 401K or your or taking money out of your IRA. You use your savings before you go to that.
So you have the rainy day fund and then the really rainy day fund.
The NOAA, the
snowy day
40-day
fund.
fund.
Really, really raining, right?
This is really, really, really,
Gotcha, cool,
Yeah.
thank you.
Like if, say, there was some disaster and we had a building that blew up and we needed the money for making accommodations, but we knew we were getting insurance money at some point.
Yep.
I could see doing something like that.
Thank you.
So the next slide is a look at OPEB. OPEB stands for Other Post-Employment Benefits, and it means other than pension. So the town participates in the Norfolk County pension. We pay, they're on a funding schedule. We pay an annual pension assessment. For many years, municipalities across the country did not, were on a pay-as-you-go basis for health care for retirees. So there was a huge liability building. We are now required to update what that liability is every other year, report it on our financial statements. We're technically not required to make progress to funding that liability, but at this point, if you were not, you would have a serious credit rating impact. So the bar graph here shows the amount we now appropriate annually towards the OPEB liability. So you can see there's been a dramatic increase over the last 10-year period.
And this is for all our employees, both municipal and school.
Municipal and school. So in 2011, we put $20,000 towards the liability. In FY20, we have $1.4 million in the budget. And really, we got to that in two places where we show with the arrow, where the town made significant changes in the health insurance budget, health insurance program. We had some budget savings, and they were redirected from the health budget towards the OPEB annual assessment. So instead of that going to other areas of the budget, it went towards the OPEB liability. That allowed us to not have to take new revenue, say from University Station, to fund OPEB, or to take away from our school or municipal budgets. So we've really built up a quite strong appropriation. We are on track, our funding schedule, to increase that appropriation by $25,000 a year. So a relatively minor increase each year keeps us on track. As I mentioned, we have to have the study updated every other year. We're currently having our study updated. It will be completed probably in February. We are not looking for the results of that study to change what we're going to do in the FY21 budget. We would stick with the increase of $25,000. But we would look at what that result is, and do we need to determine anything different going for longer term.
Pam, do we know what percentage of school and municipal employees actually get health benefits or buy health benefits from?
Yeah, it's actually about 50%. It's probably lower than what you might think. Yep. And that's all in the annual calculation that the actuaries have to do. They have all that in. How many employees currently take health insurance versus who are offered it, what's the expectation in retirement for what people will do. The funding each year goes into a separate trust account. We currently have a balance of $10 million in that account. As with other trust accounts, it earns its own interest, so the account continues to build by that as we fund at a more healthy schedule. So this has been an area that was a huge concern about 10 years ago, and town has done quite well. And with the town, I mean the select board and the finance commission and town meeting really made an effort here to address that. And so really now we're on track and just try to do minimum increases each year to stay on target.
So obviously, when they project future costs, it's based upon the 50%, not on total employees.
Yes. And what we normally do when we have the update is sometimes the actuary comes into the select board and goes through. There's all kinds of things that go into the liability update. It's projections on who might take health insurance. It's expectation on increases in healthcare costs, any kind of change in program offerings, that type of thing. As well as what are you funding? Like with other long-term liabilities, you get credit. The better you fund, the better it works for your liability. So we're looking at probably the February timeframe for that to be completed. Again, we're not going to we won't be chasing the budget and change our 21 budget for anything that comes out of that, but we will be reviewing that plan, and that might determine what we have to do for FY22.
So just to put a bug in your ear, when it's appropriate but not in the middle of all our hearings, I think it would be good for us to have another presentation. We didn't have one after the last review, so it's been at least 4 years since we've had one. And I think it would be helpful, since we don't have Peter Neville here to carry the banner. I think you're in charge of that one, Peter, aren't you?
I was last year.
Yeah.
Maybe I am this year.
Yeah, I think you are. I think you are. I think it would be helpful.
Yes.
To hear some.
And the firm we use and the partner from the firm is very good at coming in and explaining it in very easy to understand terms. It's a very difficult issue and liability, but she does a great job in kind of going through it. So
I think when we were looking at it 4 years ago, we were looking at, the formation of the committee within the town or the trustees of the fund, and that sort of, and what kind of return we were getting and all in an uncertain interest rate environment, so.
Who determines the discount rate that is used in the forecast?
who determines it? Yeah, it's part of the liability update.
Right.
The actuary will look at what your options are. They look at what are you actually earning. So our $10 million does sit, we invest that through the state program. We don't invest that on our own. The state program that does all the retirement investment has an OPEB wing, as you will, and we participate in that. So they're looking at what are you actually earning, what rates should you be looking at. We're required in our financial statements now to show variations and sensitivity analysis on that for both our pension and OPEB. So they'll show what our liability is under different discount rates. And our liability that we report each year, the auditors have to go through that also and look at that. So you could not have a higher discount rate just to make your liability look good. That's something they're going to pick up.
So we have no unfunded pension liabilities, just OPEB.
Well, we do on pension. We're part of Norfolk County. The state mandated that pension plans in Massachusetts be on a fully funded schedule over a 30-year period. We're about halfway through that period. So there is an unfunded liability, but each year they have to get their update every other year. They have to set their assessments to communities based on meeting that 30-year.
So when we get our bill, when you get your bill for that includes funding
Yes.
unfunded pensions. And
Yes.
then that's on the municipal side. And the state side, teachers are through the state, pay through the state?
Yes, so any non-teaching staff or municipal staff is in the Norfolk County pension system. And it's a mandatory participation for anyone over 20 hours a week. Teachers are through the Mass State Teachers Program. And that liability and that annual assessment does not run through our budget. The next two slides show debt, and we did already kind of go through that, so I can skip along here. The only thing I'll point out is in the middle there, we have about $6 million in debt that town meeting has authorized that we have not yet issued. And we have those couple of amounts listed there. So you'll see some activity on that as we go forward. But these are the same slides on the debt that we already went through. Just a quick look at the meals and hotel tax. And these slides are kind of dense only because they have just the background on when the town adopted the meals tax. It was a local option revenue that the state let you have. The bar graph on the left shows what we've taken in each year in the meals tax revenue. So kind of once it got started and once University Station came online, over the last couple of years, we've seen an increase. We took in $449,000 in FY19. The hotel tax revenue is the bar graph on the right. And again, that only kind of got going once that Marriott Hotel came online. In FY19, $330,000. We get this money quarterly. The state collects it. We do not. And they turn it over to us. So the bar chart on the bottom shows you the quarterly payments for our last 2 quarters for meal and hotels. So kind of a revenue source that came with University Station, now about $800,000 a year. When the select board was considering whether to ask town meeting to adopt this local option, they were very specific that we would not use this revenue towards our operating budget. Town meeting in 2017 set up a separate account that this money goes into, and it's reserved. It takes a town meeting vote, 2/3 town meeting vote, to use the money. This bar graph shows you what we have in that account at the end of each fiscal year. So for the last 2 town meetings, we have used some of this money. The first couple of years this was in place, we did not use it. We let it kind of build up to see where we were and to get some money into the account. But in May 2018 and 2019, we did utilize some funding towards capital projects. And capital projects that tried to benefit the whole town, like projects for the pool or fields, or something large for the school or municipal or building project. So after town meeting vote in May of $515,000, the balance in the account was just over $1 million on June 30th. With our first quarter coming in September 30th, $1.2 million. We have one other kind of savings account, a capital stabilization fund. This bar graph shows the balance in that account at the end of each year. So we currently have $1.5 million in this account. So this account was set up in 2009 over on the left-hand side of the graph. You can see that there really was no money being put into the account for a number of years. There is not currently an ongoing revenue source into this account. We were able to build up some balance in the account with one-time revenue, FY16 and FY18. We've only used this account once. Takes a 2/3 vote at town meeting. At the 2016 annual town meeting, we used $650,000 to totally replace the turf field at the high school and the track. Other than that, we have not used this, currently $1.5 million.
Is this the same rainy day idea as the capitalization and the free cash?
This is not. That's a great question. Thank you. This really is to save and use for capital projects. This is really a good tool for the town to say, we know the turf field needs to be replaced every 10 years. Let's put aside some money each year until we get there so that it's available when the project comes. So this is an account that we should be funding and spending. This is not a rainy day account.
Well, if you're gonna fund it and spend it, why not just spend it on the specific project?
And that's in a sense what we've been doing with the meals tax. There's been some discussion and probably will continue this year. Should we be using some of that meals tax or other revenue to fund this account? But what you just said is the choice the town's made the last couple of years, to not put into here and to use our money to kind of fund a specific project. But that's really what the intent of this account was, is to help us build towards projects that we know are coming so that at the time they come, we're not trying to fund that money in the budget. So there's not been a lot of activity.
Yeah, prior to these being established, we weren't allowed to save any money from one year to the next. So to do a big project, you had to issue a bond and pay for it. You couldn't save up money. And this was a way of saving up the money.
Yeah. The DOR came out with some tools that said a town can set up any account that they want to save money in. Takes town meeting vote to set up that account. But the town chose to do one for capital. And again, it's not really been an active account, just the 2 one-time revenue appropriations in, the one use for the turf. But this is something, that there's another turf field in town, that practice field behind the high school, that's coming up within the next early time frame for replacement. This might be a source of funding that. But this is more an account that we would target to spend on capital items to help us save towards capital that we know is coming.
Couldn't you get more bang for the buck, though, by using this account to pay for interest on a bond, so you could get a bigger project?
So if we had a ongoing healthy revenue source and could really build this, we could definitely use it for that. If we came to a major project, we could say, if it's an $8 million building, we have $2 million in this account, we'll only borrow $6 million. Exactly.
No, I meant use this account to pay for the debt.
For debt service.
You could.
The debt service.
You could, yep. You'd be voting that over each year, yep.
Question more for Nancy. Given this account, has the select board thought of changing the way we fund this and to fund more to earmark? Because we know we have a whole bunch of large projects coming. Have you thought of budgeting this in a different sense to get more money in here, to earmark more for?
Into this account?
Yeah.
One of the things we're thinking of, I'm not sure if this answers your question, Peter, but, and Pam is touching on things with the meals and hotel taxes, potentially having a piece of that annual revenue flow to this account regularly.
Okay.
Because the meals and hotel tax is still fairly new for us, we waited a few years before we used it. We haven't gotten into any kind of predictable pattern on how we use it. We're looking at specific needs as they arise and saying, does it fit? Are those needs kind of town-wide? Because the revenue comes from a source that we want everybody to benefit from. But we are thinking, not necessarily taking the action yet, to have a piece of that meals and hotel tax flow as a regular source.
Okay. I was just thinking, there's so many buildings. I mean, there's no way to avoid Station 1 at some point in time.
Right.
And,
Right.
and to the extent that we budget conservatively every year, is this a spot to really earmark it as opposed to you roll into free cash? Just a thought.
This won't go to, this money, meals and hotel tax won't go to free cash.
No, I'm saying more because we budget conservatively.
Yeah.
We do have funds available.
Yeah. We are looking at things like that, and you're getting the right sense. There are a lot of capital items that we're responsible for maintaining or reinvesting in or replacing, and we have to be thoughtful on setting ourselves up to do that in the best way possible.
Okay, thanks.
The next two slides I won't go through, but they're just, on our financial policies, we self-report each year on where we stand against each policy that has a financial target. So these 2 pages show you that. We do include those in the town meeting warrant book to send out to everyone. So we're always kind of looking at what's the target, where do we stand against that target? And this is a document we would share with the rating agencies. So I know I'm going long, I'll just,
No, you're not,
No?
because
Okay.
we gave an hour for you and a half an hour for our questions, and we've been asking, so
ask as you go. Okay,
the lights haven't turned off yet, so.
next we were just kind of recapping where we were with the current year budget. Again, kind of as background before the select board started the next budget year. So in FY '20, this is the same chart we looked at, $102 million expenditure budget, with almost 70% of that coming with our annual operating budgets, school and municipal. This is the same slide that shows the breakdown of that and shows the percent changes for the last couple of years with each category. In the current year, the next couple of slides look at capital. This slide, the bar graph, shows how much we spend each year on the base school and municipal. So we have 2 articles at town meeting for capital, one for school, one for municipal capital that we consider our base capital. In the current year, FY '20, $2.3 million. And by our financial policies, we should be spending about $2.4 million. You can see on the left-hand side of the graph, for many years, we were not meeting the target. We were not spending enough on capital. And there was a real effort made over the last several years, and as our revenue picture improved, to increase our spending on capital. So you can clearly see that by the graph that the town meeting has been achieving that and putting more towards capital each year. But because we had many years where we weren't meeting that, as we look on the next page, the last couple of years the town has done an additional capital article each year. So FY '17, '18, '19, and '20, we've had capital beyond the base. And we're really trying to make up for those years where we were not fully meeting our capital year. So here we're trying to get at projects that would not fit in those base capital or are larger projects that need to be done. So again, the pool renovation, field projects, large HVAC projects for town or school buildings. In the most recent town meeting, we spent $1.3 million on that additional capital, and the funding source was free cash and the meals and hotel tax. This slide, I was just talking about some of the steps that remained in the current year, getting the property value certified, the tax rate certified. Since this presentation has been done, that has happened. Our tax rates are done. We'll be sending the actual tax bills, excuse me, out to our residents. We never like to, we don't put those in the mail until after Christmas. But you'll get those the week after Christmas. Some people like to come in and pay that before year end. So we run the registers, we have the tax information, but we won't mail it to you till after that. And then finally, the last section looks at the preview for the FY '21 budget, the budget we're working on now. So the select board always talks about what are their goals with the overall budget. And the number one goal is to maintain the high level of services provided to the community through the school and municipal departments. Again, though, trying to do that with sustainable, moderate growth budgets. Continue the high level of capital investment, both the base capital and additional. Continue the progress that's been made with the OPEB liability, keep up with our stabilization account. This year, we'll be starting to talk about those larger projects that are coming, the school project and other large capital. And every year, we're trying with efforts to limit the growth in the tax bill. Not utilizing the full levy, other things we can do under Prop 2.5. So those are the components of the budget that they're working on. When we do our budget projections, we're always starting where are we today, because we're balanced today. So what changes as we look towards the next year? And we start on the revenue side because of Prop 2.5. So this is the same slide we've looked at a couple times tonight. We know where we are in revenue today. We start our budget process by saying, how would that change for FY21? And so we're going to start that by doing the same little chart. This is not the most updated one. As we go through the budget cycles, you'll see this updated for the numbers. But again, our main revenue drives by a formula. So when we say, well, what revenue will we have available for the FY21 budget? It's going to start here. When we look at revenue in general, we'll have the revenue from taxes. So the increase of 2.5 and the estimates for new growth would be about $2.5 million. We'll look at what do we budget for state aid? Would we level fund? Or would we expect to see something different? As Peter mentioned, they're changing the Chapter 70 formula, so we may see additional revenue. With the state budget, the governor comes out with his budget at the end of January. So typically in our budget projections, we'll level fund until January, and then we'll incorporate whatever the governor's budget is. Our local receipts budget, we typically level fund. And then with free cash, we're applying some of that towards the capital stabilization, as we've already discussed. One area in the budget, as we look again year to year, it's the fixed cost budget. So this is the current year's fixed cost budget, $15.2 million. So I think it was earlier, Chris, when you asked, how does that break down between school and municipal?
Got it.
And this we have here. So on the employee benefits portion of that, $13.8 million, just over $7.7 million is for school employees, and municipal, $6 million. And again, this is all pension, health care, payroll taxes, unemployment, workers' compensation, all of that is in this category. In the budgets we vote at town meeting, we show the detail of those various accounts, but it is like a bottom line budget. So one of the first things we do in our budget projection is say, what's going to happen to that fixed cost category? So right now, we are estimating that that fixed cost category is going to go up in total just over 6%, or $920,000. And then the bullets show you the various portions of that. So our pension assessment from Norfolk County, we know. They already know what their assessment to us is because they're on that automatic funding schedule. We're going to have a 7% increase, up to $5.7 million. We need to set aside $381,000 in the FY21 budget to meet that. Our health insurance projection is a 5% increase, or the total budget of $6.5 million, so $310,000. Our other categories, the increase will be $200,000, and I mentioned the OPEB already, $25,000 is increase per the funding schedule we're currently on. So that's a big increase and a big chunk of our available revenue, $920,000, that we need to set aside first to meet these obligations with our fixed costs.
It says your health insurance is estimate only. Is that still an estimate? Until you-
Estimate only, so on the bottom, we're showing the timing on the health insurance. We participate in the State Group Insurance Commission. They work on their budget now. In February, they usually come out with any plan design updates, and in March, they set the rates. So we don't have the update on the health insurance budget until the March timeframe. We try to make sure we do our best that this estimate should be the ballpark of what we're looking at, that there's not any wild fluctuations, but this is an estimate only.
How does the estimate compare to prior years?
Sorry?
How does the estimate compare to prior years?
So this current year was about 5%. Going back 5 or 6 years, we had some years where that was a 10 or 12% increase, which is a dramatic hit to the budget, and it's very difficult. Where our revenue is kind of limited, what we have to set aside for fixed costs limits what we can allocate to the school municipal budget. So the 5% has been steady the last couple of years, and that's certainly been helpful in the overall budget.
Pam, is this an item that's negotiated with the unions, or is this fixed, separate, outside the contract?
The contribution is fixed between what the town share is and what the employee share is. But we participate in the group insurance commission, so the rates and the plans are done by them, not by the town.
Okay.
And then looking at budget projections for our operating budget. So again, we're showing here what our total spending is for school and municipal budgets. Each 1% increase costs us in total $687,000. So $465,000 to increase the school budget by 1%, about $222,000 to increase the municipal budget. So then we've shown you on the bottom there, if we went up 2.5%, 1.7 million, 3%, 2 million. We show this because it's easy to say, 2.5% or 3% increase is not a lot for the operating budgets, and it's certainly not, but the dollar amounts add up quite quickly. The next slide, capital. In our early projections, we're going to try to meet the same level of capital spending as in the current year. So the base capital, 2.3 million. That's our overall preliminary look as far as fixed costs, operating, and capital for FY21. That finishes the very large package of that.
This one will be a short one.
One last little bit just on University Station, because it is the most asked question that we get. So we just have kind of a quick little piece here. And we'll be talking about this more in the budget. Thank you, Laura. So University Station revenue, as we looked at, commercial value can provide significant help to any town's budget. Before University Station even came online, the town went through a series a process of looking at how would we utilize that new revenue. We've listed the items here. Providing for any direct service costs, so if we needed to increase police or fire to service the project, we needed to pay for that. Helping our budgets, the school and municipal, with sustainable growth, help limit the tax increase, help pay for capital projects, help the commercial residential split, help maintain our bond rating. Before the project started, the estimate of new revenue in total from the project was $5 million a year. Our associated direct cost estimate was $2 million. Net annual revenue, $3 million. So that was all before the project started. This is a graph we show a lot. Some people call it the octopus graph, as opposed to our scale graph we show. But just the new revenue coming in, we were trying to make sure that that reached as many areas as we could in the budget process. So what have we actually taken in and how have we actually used the money? That's what these next couple of slides show. The bar graph at the top shows the additional new revenue each year from University Station, starting in FY15 when the project first came online. This is additional new revenue each year, that new growth each year. So you can see what's come on each year, a cumulative at this point, $5.9 million. That's new revenue. The project, kind of the land value there before the project started was about $2 million. So right now in total, that property contributes $7.9 million a year in tax revenue, annual tax revenue. the next couple of slides look at how have we used that 5.9 million additional new revenue in the budget. First, we've used the largest portion of it, $2.6 million, to help the school and municipal operating budgets. So on that chart where we showed the increase each year in FY 15 and 16, we provided additional money to those budgets because they were coming off a couple of years where we weren't even able to meet the 3% increase. So in those years, we did apply additional revenue. So 2.6 million, just shy of half of the total of that university station revenue is now within our school and municipal budget. Second, direct service cost. We've used $1.9 million to provide for the services built into our budgets what we need to service that area, with the majority of that $1.6 million towards the municipal budget, particularly police and fire. Third, capital. $892,000 in ongoing capital for the bond for the police station, and then a small amount from May town meeting for the first portion of the road bond. And then we used $975,000, one of the first years that the university station came online, we put that into that capital stabilization fund that we were just looking at. And then finally, each year, there's been a piece of unused taxes that's helped subsidize tax bills for all our residents. So the chart here shows you about how much each year, almost $500,000 on average each year. What that means is we've taken in additional revenue from University Station, but not built it into the budget, not spent it on new things. So that revenue comes in, helps subsidize the current budget in place, gives all of our residents a bit of tax relief in their bills. So that's how we've used the money. The next two slides just actually show a little bit more detail beyond that, each year, how that money's been used in each of those categories. Again, we get asked all the time now, what about University Station? It has certainly been tremendous benefit for the town. $5.9 million in additional annual revenue, helped significantly with that commercial residential split, which helps our residents' tax bills. We've used it, in all kinds of different areas in the budget. That being said, it is only so much. It is one commercial area. It's really not the same as some other towns have, where they have much larger commercial projects or more of those kind of areas. If you go up and down 128, there are communities with much larger commercial portions of their budget. So it's been a tremendous help to the budget. We would not have, you just saw how we applied it, we would not have the school budget or municipal budgets that we currently have without University Station, meaning we would have less services in the schools, less teachers, unless we asked for an override. So early on, we looked at, we've not had an override general override since 2007. University Station's been a major part of that. That has helped us have the services that we have today without going back to our residents and asking for an override. So that money's been used to build into our budgets, help us maintain our services, provide some relief to tax bills. But no, it is not large enough to never have another tax increase in town or drive down the tax bills. It's just simply not that big a development, but certainly been tremendous for the town in so many ways. But we do like to show how we've used each and every dollar of that new money, voted every year at town meeting, but we've applied it to many different areas in the budget.
Meals tax is not included in that additional revenue.
And that's a great point, thank you, Howard. The meals, this is just strictly the tax dollars, real estate. The meals tax really is an added benefit from that project. All of the meals and hotel tax revenue is coming primarily from that project. And the select board, when they asked town meeting to approve that meals and hotel tax, you wanted our residents to benefit from other people coming to University Station and eating at the restaurants or staying in a hotel. All of us residents of Westwood, going to Patriots Place or Legacy Place, we're paying that meals and hotel tax revenue to those communities. So the meals and hotel tax came directly as a result of us having University Station. As University Station continues to grow and new restaurants added, we're going to continue to see the benefit of that.
Pam, you can make the argument the 5.9 million is a tax relief.
Is what?
The revenues, the additional revenues, I guess, offset by the cost to run it with the fire in the schools, et cetera, that's all a tax relief, isn't it?
It's all tax relief, is that what you said?
For residents.
For residents. Is that what you're saying? It's a tax relief? 100%. I mean, if we didn't have that revenue and we wanted to do the same things, we would have been back to our residents.
Exactly.
So it's I know some people wanted that money to drive down the tax bill, but it prevented the tax bill from going even higher. If we want the school system that we have today and the municipal services, we would have had to have come to the town and asked for overrides to do so. So University Station revenue has let us have the services that people want without coming back. So it's really been a, cost avoidance on the increases in the tax bill.
Either that or the level of services would have declined.
Or the level of services would have been down. Absolutely.
Pam, in a town meeting in 2018, we appropriated $1 million for an affordable housing fund. I was looking through your Bible and didn't see it. Is it lump summed? Is there a line item for that specific $1 million, or is it lump summed in another account? I was looking through your Bible that you
Yeah.
have in your...
So we voted that as a town meeting article, the same as we might vote a capital article. The town did not set up a separate account like we've talked about some of these other ones.
So where
That
would I-
town meeting just voted that article. So that's why you don't see it where we show the stabilization fund or the capital or the meals. It wasn't set up in that same way. It was just town meeting appropriating $1 million in an article. So articles voted at town meeting stay open until they're used. They're not in a separate account. They don't keep their own interest, but they can remain open until used. And none of that $1 million has been used to date.
Okay, so where would I find it? Under what account would it be under? Is it in the free cash? Is it under?
It's not in free cash. It's the same as if we appropriated, if we appropriate $600,000 to do the turf field at the high school. It's kind of set aside on the town's books. That might take more than 1 year to do that kind of project. It remains open. It doesn't close to free cash. It's an open article. Almost the same as if you vote, money for the police department or the school department, but those close out at year end. So the article is there and voted, but remains open until it's used.
So is there just a separate ledger
There's
to
a
spend it
separate
down?
ledger account.
Okay.
That's exactly it.
All right.
There's a separate ledger account for that.
In that same warrant article, it said future building permits, maybe Nancy knows, future building permits was also supposed to be added to that account. Do we know if any additional monies were added to that account?
So right now, we could not add to that. If the town wanted to have an account that had more revenue flowing into it, we have to adopt and set up an account like we did for the meals and hotel and the capital. We'd have to establish that kind of account. That was.
The warrant article, I have it here, says, let's see, the funds allowed from past and future building permit fees was to fund, so were we stuck at, it's only funding $1 million?
Yes.
Or is future permitting fees going into that too?
It's only the million.
Just $1 million?
Not only $1 million, $1 million's a lot of money. It was only that town meeting vote. I'm not sure if you're reading from the vote or the article, but the vote was very specific like other things. We used some free cash, and there was some balance left from some University Station money. It was appropriated to one source. If we wanted, again, to have a more ongoing housing account, we would set up one of the accounts that we're allowed to do that with.
Perfect, thank you.
That was in what year?
2018.
And it hasn't been used yet?
It has not been used to date.
Do we want to get an update from our select board?
Well, it would be unfair to put her on the spot right now, but maybe in a future meeting, that would probably be a good thing to talk about.
We met our 10% threshold, right? I mean, I think part of the 2018 vote says here was to meet our 10%, but according to Mike Gillette's Wire report that came out last month, we've met our 10%. Right? You might not be the right person to ask, so.
We think we've met it, but let's see whether the state thinks we've met it.
Didn't that account have more to do with maintaining some of the housing, the houses that have been gifted to the town that we use as 40B? Yes, you're going to have to come up. We want to keep you awake.
I'll do my best, I'm not the housing person. Okay, the $1 million was voted and approved to use towards investing in housing that would be changed into affordable housing units so they could count on the SHI, the subsidized housing inventory. To date, none of those funds have been spent. So that's the first part I want to. There was another question floating around here. Chris, you had something.
No?
Okay, so just to clarify, so.
So this would be adding more. This was not.
Yeah, oh, I know. Jim, you were talking about,
Right.
we right now are over 10%. This is December 2019. What we've been working so hard towards is when the new census comes in, 2020 census, and the state determines what our inventory of housing is, we got an updated calculation. Today, we can't say definitively we are over 10%. It is a very close call, which is why so much attention has gone into places like Westwood Lodge, special permit, having affordable housing units, any other development discussing having affordable housing units, how to booster this up over 10%, but that's to be determined. We can't say today.
As Chris said, it's our opinion that we're at 10%, but the state may
No,
not.
we can't say today that we will be next year. We know where we are today.
Right.
But isn't it as of January 1, 2020, we're good for 10 years after that point,
We
right?
are not at January 1, 2020 with the census and the state telling us what our inventory of housing is. So, for instance, question marks, Gables, no, Bridges at University Station, we believe the state will say that counts as housing units in the numerator. When we first approved that, it was believed that memory care facilities did not count as housing units in the numerator. So that moved what we thought, and it wasn't unique to us. There was a law case that came out that made us believe it otherwise. What the state actually does, we will find out in a few months.
So it's up to interpretation of memory care units.
Yeah, I don't know if interpretation is the right word. It's probably some legal opinions. Do you call that interpretation?
Yeah.
Okay, you're the lawyer, I'm not.
You said you're not the housing person. Is there somebody else we should be asking the questions to? Who's the housing person?
Well,
we're
there's a
referring to?
housing authority, and then Sarah Bouchard is our housing agent. She's the staff person. And just recently, as in the planning board's last meeting, they voted to approve, what do we call the housing? The housing report,
plan?
housing production plan. And that's something that indicates what the town is doing towards addressing diversity in housing. And it will come to the select board next week. It was supposed to be last night. It will be next week. And then that plan can go to Department of Housing for their review. And if we are under 10%, that gives us a year reprieve, if it's been approved, to work towards achieving being over 10%. It's almost like a stay is given to us to work towards it. And that's
Because
why
that-
that plan is so important to get filed and approved. So Sarah was before the planning board. She'll be coming to us Monday night. So, either of those discussions will be on Westwood Media Center, might be worth listening to.
Great, thank you.
Doesn't she do a great job?
She does. She does a great job.
I appreciate your time, that was long, but it's always helpful for us to go through all that with you, and then when we start moving through the budget, you've got a background on where we are.
It won't be the last time we'll see you this budget season.
You'll see me a lot.
Nobody has any more questions for, now that we have Mrs. Hyde on the hot seat too? We're all set? Okay, thank you very much.
Thank you.
Sorry, yes. Any public questions? Yes.
Good evening.
Sure,
You don't need to do that.
I don't need that.
No, you can just speak because it's.
Not in North South Beach.
Well, no, she needs it for, you
This
need
one,
it.
Is it the one,
What do I need?
You need a microphone.
that one?
Thank you. I have questions, comments, and concerns, and I guess I'm going to start. I'd like to see a stronger emphasis on a freer flow of information. As an example, I'm here and I can't follow along with you because there's not a packet for residents to take the time to come here. It would have been easier, and I could have written down my notes and been able to find them easier. So that's my first comment.
Okay.
My second comment is with respect to the $1 million affordable housing account. I still don't understand where that money is. I understand that it hasn't been spent, but it's got to be somewhere in our budget, in our financial statement. No?
It's absolutely on our financial statement. Every penny's on our financial statements. I'm not going through financial statements tonight, but happy to send those out.
Well, then I'll just elaborate more then, and maybe you can follow up. I've been looking at the financial statements since 2014. Actually, the annual reports that Westwood files with the state. And I'm trying to interpret the information that you provided tonight. And I guess my first question, the building permit slide that was up on the screen, for the final fiscal year 2019 revenue was $782,000. Does that include just building permit fees from University Station, or does that include the ancillary fees, which include like the electrical, the plumbing, the inspections?
All of it. Yep.
The 782, and then for fiscal year 18, it was $682,000. Because for fiscal year 18, the warrant article at town meeting, what town meeting approved was they authorized $1 million to come out of different accounts to the establishment of the affordable housing account, but we also authorized that all of the building permits prior to the town meeting vote and after that will be designated and earmarked to go into the affordable housing account. So I guess my question is, we have $1 million somewhere, but we've added money, and also we've added money from the Citizens Bank. Because Citizens Bank, what we approved was everything for building permits, which turned out to date, I think it's like $148,000. I was able to confirm that. So I'm trying to figure out where is this money?
Can I just clarify?
I don't know if
this?
anyone else is concerned about that.
I think when you're reading, I think if you look back at the vote that set up the $1 million, you'll see by your discussion of that you're not kind of looking at it correctly. At that point, there was a closeout of building permit revenue with University Station. The development agreement had identified how the building permit revenue up to that point was going to be used. We had to inspect the project, do different things. The project had then reached, kind of almost full build-out. There was a balance remaining. It's that balance in the building permit at that time that was used to fund a portion of the $1 million. It's not the ongoing building permit revenue from University Station or any other accounts. there was a balance from the development agreement at that time, and there was a closeout. That was a portion. It was supplemented with free cash to get to the $1 million item. And that discussion was because in the development agreement, there was some housing support from the project, if I remember, and that's how it was closed out, was town meeting voted to say, take the remaining balance, and instead of the project doing something, gave the town the authority to do housing work.
Right, because that would make sense. If you're expecting a certain amount of money to be generated per year off of permitting, et cetera, you're not gonna stop that and have it directed to a different
No.
fund, because now you can't make that up in the general fund, right? So
There's been building permits from University Station since that time. It's all general fund.
which is
revenue.
separate. So I think, because I get confused with
Yeah.
that question you asked as well.
Yeah.
So it isn't all of the permitting, as I understood it. It's not all of the permitting monies, future monies, would be allocated to support that fund.
It was a point in time, the closeout of the development agreement.
Does that make sense?
I think, she had the same confusion that I did, that says in future building permit fees, but because it was a specific dollar amount, I think it.
You have to live, yeah.
Correct, yes.
You know, it's like some of the other language when we're doing, like preliminary, money for different projects, and we kind of have very general language that really isn't pertinent, but it includes all these elements. And so it does get very confusing, but it's the dollar amount that you have to hang your hat on. Okay, any further?
Thank you.
Well, the bottom line here is
Actually,
I think-
I'm not trying to make anyone offended. I'm not trying to insult anyone. I'm just trying to understand this. We have, let's see, July 22nd, the Board of Selectmen, their minutes indicated that they had allocated funds to Westwood Affordable Housing Associates, which is our nonprofit that will accept funds to maintain or create affordable housing. So on July 22nd, the selectmen minutes, or the select board, minutes say they've allocated money. But when I requested specifically how much money has been allocated to date by the select board, I got an answer that nothing has been allocated. And I don't understand how the select board can allocate funds, but yet when you ask how much has been allocated and the dates of the allocations, the amounts of the allocations, and the source of the funding, I get an answer that says zero. I don't know how to interpret that. I mean, the minutes say they've been allocated, but yet my question, my specific question is like nothing has been allocated. I'm just trying to make sense of this.
Well, I'm concerned too, but I don't think tonight is the appropriate time to try to delve into what's going on here. We've put the select board on notice that it's an issue that we're concerned about, so let's give them time to come back and fully explain it, probably bring the
Yeah.
housing authority person with them.
Okay, I appreciate it, thank you.
Okay, that's it? You all set? Well, it's really not, it's not the appropriate venue for this discussion, but you've raised issues, and we'll be aware of it now.
And I appreciate it, but I've been following along, and I've been trying to figure out where everything is.
Yeah. Anyway, yes, and I
that's
appreciate
it.
your comment about
Thank you.
having the packets beforehand, and we will try to do that. And sometimes it is available online. I don't know whether it was tonight or not, so we'll try to make sure that,
Information will probably be available online tomorrow,
Yeah, we'll-
possibly.
we'll try when we have these to have them available at the door for people coming in, because we do have, obviously, we have the packets ourselves, so we'll make them available. Anyway, are we all done? Okay, thank you. We can release you guys. We just have one item left to do unless anybody else has anything. It's just approval of the minutes from November 12th. We're better at that. And if I can have a motion, they're attached to the agenda.
Motion to approve.
Okay, second? Second. Any changes? The lights are going, so we have to do this fast.
He's here, Pat's here.
Okay, no comments? All approved?
Aye.
Any opposed? Okay, approved. And I think our next meeting is January 14th. At that time, they will have already closed the warrant articles, so we'll probably have our first meeting of a summary of all the items. So we will see Chris again on all the articles. And at that time, we will kind of very broadly assign out the articles for the book later. And we don't know really what articles are coming. And
Better not miss that meeting.
That's right.
yes, you missed that meeting and that's it. I
Everybody
told
come to
Howard he
that
didn't
meeting.
come to the last meeting, he was made chair. Anyway, nobody have anything else? Then I'll have a motion to adjourn.
To adjourn.
Second?
Second.
All in favor? Aye. Okay, great, thanks.
Happy holidays, everybody.
Yes.